Welcome to Barchart series of educational webinars designed to enlighten you about a variety of trading ideas and concepts, inform you of the features and tools Barchart provides related to these concepts, and offer you some traders' insight to help you make a more informed trading decision. Today's session, gap trading, the end of the road pattern. Now, in Edwards and McGee's, in their book, Technical Analysis of Stock Trends, they identified different types of gaps during phases of trends analysis: breakaways, runaways, continuations, exhaustion, and reversal. So today's session, we're going to focus on a particularly unique and distinctive reversal, the end of the road gap. Now, that is when trend ends abruptly after an extended or parabolic movement. Now, most traders are familiar with the adage, the trend's your friend until the bend at the end. Well, the end of the road gap is that bend at the end when price literally falls off a cliff as market sentiment swiftly shifts from bullish to bearish. It potentially starts a new downtrend. Hello, everyone. My name is John Rowland, Barchart Senior Market Strategist. And, I've been trading for nearly 4 decades, and I can tell you there is no chart pattern as simple and pure as the end of the road gap. First, because of its visibility. Second, its easy recognition of technical confirmation. And finally, its reliability to produce high probability, low risk, high reward setups. So stick around as I review the characteristics around this dynamic gap and offer some trade setups to take advantage of its high probabilities. Now, before we get to that, please welcome our moderator and Barchart's project director, Jean Baker. Hello, Jean. Are you there today?
Yeah, I'm here just barely. Right before we went on air, I lost my internet connection, but back up and running. So all good.
Excellent.
Yeah, all good.
All right, Jean. Well, I rely on you. I can't do this alone. You know that.
Well, I'm here to answer questions or to direct them on to you as this webinar progresses. So people feel free to send your questions in, and why don't you go ahead and get started, Jen?
Thanks, Jean. Just a reminder that today's session is for educational purposes only, and decisions to buy, sell, hold, or trade securities, commodities, or any other investment involve risk and are best made of the advice of a qualified financial professional. And under no circumstances shall we be liable for any loss or damages you or anyone else incurs as a result of any trading or investment activity that you engaged on based on the information or material that you receive to barchart.com and our services. All right, gap theory. So why is it important to understand gap theory? Well, because understanding the dynamics that are behind gaps and the role they play in trend analysis is paramount in trend recognition and discovering of trading opportunities. So they represent the most significant imbalance between buyers and sellers. And in other words, a gap is a void of price, and price is a record of a transaction. And a transaction can only occur with both a buyer and a seller. So therefore, gaps are evidence of a market that is void of either buyers or sellers. Now, there are different types of gaps, and they represent different phases of trend. Breakaways are usually the beginning of a trend. Runaways are continuations. Exhaustions, completion of a trend, and then reversals, which is the death or the end of a trend. Now, endings are also beginnings, and that beginning could be a new opposite trend. Now, gaps have an uncanny behavior that attracts price into it, only for it to then remember or recognize why that gap was created in the first place, that imbalance between buyers and sellers. So herein lies the opportunities. It's a high probability that price will return in the direction of the gap. And that's the importance of understanding gap theory. Now you can, there are different types of gaps, and we have a couple webinars on gaps and gap theory. But we're going to look at something called an outside gap today. And an outside gap is where price opens above or below the previous day's high, above or below low. And these are easy to see on our charts because they are represented by a void of that price. But they're also powerful because they really spell out this imbalance between buyers and sellers and what they represent. In other words, we have an explosion in price action, and that could be confirmed by an explosion in volume. Now, typically, the first impulse drives price with a directional strength, sometimes referred to as gap and go. Now, gap and goes are difficult to trade because of timing. You got to be right there at the time. But we'll discover that after that first input fades, there's a retest of that gap, and that will present a great trading opportunity. Now, most gaps, right, or outside gaps, will have some type of catalyst. And those often revolve around a news story or a change in fundamentals of that underlying asset. And we could be talking about different types of assets, commodities, Forex. But when we talk about individual stocks, then what we're really kind of talking about is earnings, is usually that catalyst. And as I mentioned, it might take several days before price returns. Large gaps or powerful gaps or trend reversals will typically only allow a partial fill into the gap. And we're going to look at multiple data points that could influence when price might stop and reverse out of our gap. So we're going to look at a very specific outside reversal gap, which is called the end of the road gap. Now, when I was a kid, I remembered, Saturday morning cartoons. There was a cartoon called The Roadrunner and Coyote. I don't know if you're familiar with it. Maybe this is kind of dating myself. But inevitably, the coyote would chase the roadrunner down a dusty road, only for the roadrunner to abruptly stop. And then when the dust settled, the coyote would realize that the roadrunner had ran him off a cliff. To me, the end of the road gap is that moment when the dust settles and buyers are looking at each other asking, who's going to buy now? And the price collapses under its own weight. Now, end of the road gap, like I said, is an outside gap where price falls below the previous day's low. But typically, that could be multiple days. It could have multiple day lows. And it does come after a prolific uptrend or a parabolic rally. Now, prior to the gap's creation, candlesticks will warn us of a change in sentiment with, multiple types of different candles. The ones we kind of want to look for are engulfing candles or a unique reversal combination called pinchers or twins, where sellers are so eager to offload their shares, they will continue to sell through a period. Now, for instance, if I'm looking at a daily candles, they will sell through the close and then of that candle, and then will start selling on the opening of the next day. So this would be kind of what we want to look for, this combination of the close of one candle and the opening of the other being of equal value. Now, the unique, by the way, Nielsen in his candlestick book talks about these as tweezers, and there are a little bit different nuances, but we'll look at some charts and it'll be very obvious to you. So the uniqueness of the end of the road gap is a number of characteristics that repeat with each new end of the road gap. So they include breaking a very distinctive or recognizable trend line. Now, this could be of multiple weeks or multiple months, but definitely you'll be able to recognize a trend. The initial impulse will gap into and fall below a major moving average. Now, I've given a couple examples here, 20, 50, 200 days. Those are kind of just your standard major moving averages. The gap typically is greater than 2% or one daily average true range. And again, for example purposes, I'm probably going to look at probably like a 20-day moving average instead of a shorter term moving average, because that gap will influence a shorter term moving average. And then again, as I said before, there is some kind of a catalyst, a change in fundamentals, be it micro, let's say like the Fed, or if it's market specific, typically earnings. Now, when you can recognize 3 of the 4 of these conditions, well, you've come to the end of the road, coyote. Beep, beep. So let's look at, well, let me show you some current market. Whoop, there we go. Current market end of the road gaps. And then what we'll do is I'm going to show you where you can find these candidates, and then we'll go through some setups, intraday setups, and then we'll look at that first retest when price remembers why there was an imbalance and that giving us that greater opportunity. All right, so let me go here. So what I did was I just created a watch list of some examples. And so first of all, I don't know, folks, if you realized that we have some new charts now. We have some beta charts. We have flip charts and beta flip charts, and also interactive charts. I don't know if you folks have been using them, but there are some nice, cool new features. So maybe we'll get to highlight a couple of them as we go. So here is the cues. And so let's first start off with, let me kind of squeeze this a little bit here. And there we go. Okay. So first of all, we can start with that recognizable extended upward trend. You can see this goes back to about April, and that is represented by this red line. The second is that candle pattern, twins or pinchers or tweezers. Again, that green candle that closed up here, and then the red candle, as our sellers will continue to sell through 2 periods here, that drives price back down. Now, this is not truly an engulfing candle, right? An engulfing candle would be above the green candle and below it, but it could be an engulfing candle. You might also see other types of candles that are reversal type candles. You might see a shooting star or an evening star or a dark covered cloud, just to mention a few. But pinchers, twins, tweezers are really what we're going to key in on. Now, we're going to look at some examples a little bit later, but there are sometimes our twins and pinchers are hidden in lower time frames. So keep that in mind. And then the gap itself, it falls through or below a moving average. In this case, it's our 20-day moving average, and that is represented by this red line here, this kind of curvy line. Now, I know I'm going to get this question. Can I use an EMA? I'm just using simple ones here. And yeah, you can, but just remember that an EMA is just going to put you closer to current gap price. Now, the other thing I said was gaps from gap close to open should be about 2%. So if I go down here and I get one of my drawing tools, hang on, here we go. And I look at the close of this gap, that candle to the opening of this gap, you can see that range is only about 1.6%. Again, we talk about 2%. Again, this is just kind of a rough number. I mean, you could look at, let's say, a lower percentage. But the other thing I did say is what I'm going to look for is one of two. I want to see a sizable gap, either a percentage, or if I come over here into more data and I go under technicals, I can look at my 20-day moving average, 20-day average true range. And you can see that today it's 7.8. And this move here is about 8 points. So one daily ATR. So that would qualify as our gap. Now, the other one was a catalyst. So this happened on July 17th, and that was a Wednesday. You know, if you're not familiar, what happens on Wednesdays typically in the markets is you get a lot of economic data points. And on this particular day, we had the GDP, the beige book, leading economic indicators, and all of that day pointed to slower growth. And that probably was the catalyst that started this end of the road gap. But also, I wanted, before I move away from this chart, is, I want you to notice that proceeding to our peak, remember Edwards and McGee talked about these different types of gaps in that cycle of trend analysis. So here's our breakaway gap where we broke out of a trading range. There's our continuation gaps or our runaway gaps. And then this is going to become our exhaustion gap. Now, we don't know that at the time. It could be another runaway gap. But then what we did is we gapped below it. And that would tell us that this is probably in an exhaustion gap. Now, in this case, Edwards and McGee would tell you this is called an island reversal, but it not always has to be an island reversal, okay? So here's Dell. And again, notice our series of gaps as we lead to our peak. And in this case, yes, we have a nice little trend line that's been going for since December, but you can see in the last few days or last few weeks, it kind of went parabolic. And again, what were some of the things? Well, you can see this was a very large gap in terms of price action. So that would meet that requirement. But notice again, it fell below our 20-day moving average. And again, one of the other things we said that we can start to think about is those catalysts. And you can see that earnings was the catalyst that flipped this market over. Here's Eli Lilly. Again, nice discernible trend line, gap below our 20-day moving average. Now, this kind of looks like twins. Now we have two red candles. Now I will just show you this in the settings. When I do my candlesticks, I like to use open to close candles because I really want to know what the sentiment is inside of each candle. But if I change this to close, then you get that more classic green candle, red candle. But again, one of the things I said that prior to the end of the road gap at lower time frames, I could find those set of twins or pinchers or tweezers, as Nielsen would say. And here you can see, whoops, there's our end of the road gap. And notice that we did get those beautiful, this is a beautiful set of twins. So let me go to Echo Labs. And again, let's go back to our daily chart first. Again, a nice uptrend. You can see this uptrend is since November of last year. And again, our earnings was probably one of the catalysts. We fell below the trend line. We broke below the 20-day moving average. And in this case, we actually broke below the 50-day moving average. So again, if I don't see twins on this green candle, but maybe there was something that happened intraday. And again, here's a 30-minute chart. And there you go. There's a nice little set of twins. In this case, this looks like this could be an engulfing candle. It's hard to say. It looks like they're more have the same values as their close and opening green to red. All right. Now, some of you are going to jump to the conclusion, say, oh, well, because if I see twins, this is going to be a sell signal. Not necessarily. This is just more of a signal or an affirmation of things to come. All right, so where can I find candidates that are end of the road GATs? So there's a couple places where we can look. And so first of all, I'm going to go under stocks here. And here we can see on stock leaders, we have a page called gap ups and gap downs. And what I've done is I've clicked on the gap down page. So what you could do here is you could sort through these, right? You could kind of look through them all, or maybe you would go to like the flip charts and start looking at them. And now again, one of the new features that we have in our new charts is we can look at multiple charts at the same time, right? We could look for those conditions, you know, breaking our moving averages and, you know, significant price movement. But, you know, again, for today, I think there was like 150 or so. This could take time, a little bit of effort. The other thing we can do is we can start screening on the gap down page. And again, what I could do is I could pick some of those elements of those characteristics that we just talked about and, you know, use them as screening potentials in this case here, you know, I'm adding the 20-day moving average new sell signal. In other words, what I'm doing is I'm saying, okay, screen on these ones that are gapping down and show me those that are where price is now below the 20-day moving average. And so that's what I did was I went in here and I created a save screener. Now there's a little joke here, right? That the end of the road gap screener is at the bottom of my screener list. And again, for those who aren't familiar with Barchart, one of the benefits of being a premium member is I have unlimited screeners. So here is my end of the road screener. So let's kind of just walk through this real quickly. So first of all, I'm going to look for stocks that have a medium-term bullish bias. Now, this you can find this in the Barchart Technicals Opinion page that is related to, you know, all charts, or excuse me, to all equities markets. And I just want the buys. So what I'm really doing is I'm saying I want to see price above the 50-day moving average and also the 50-day moving average above a couple other moving averages, longer term moving averages, 100, 150, and 200 days. In other words, what I'm really doing is I'm identifying stocks that are in an uptrend. Then I want to see stocks that are making new 5-day lows. Again, we said that an outside gap is when price falls below the previous day's low. Here, what I'm increasing that range. I want to see a new weekly low over the last 5 days made within today's session. I'm going to look at that new 20-day moving average. Again, I want to see price below that 20-day moving average. Gap down percentage. Again, that percentage that we said that most of these type of trades are. Now, this takes a little bit of a nuance. You have to kind of think in terms of, you know, when you're back in school. So we want a 2% move less than. In other words, we want a negative 2% move, right? Downward. So gap down of 2% less than value. And then our last price change. So here, excuse me. So what here we're doing is we're going to use the last price change as a comparison, but also kind of want to know where current price is. Maybe I might be also looking, let's say, the opening price. And then finally, I have my 20-day ATR. Again, I'm not going to set a value to this. I just want to know what the 20-day ATR is. Again, I might be looking for a gap that is equal to or greater than that ATR. Now, if you're not getting a lot of candidates, or you're looking at this and you see maybe a market that you say, oh, this is acting the way I think it is, but it did hit the screener. Well, that might be because the gap down percentage is the difference between the current open and the previous session's low. Well, a real gap, or a gap that we're going to talk about in a percentage, would be from the previous day's close to the next day's open. That's really that 2% we want to see. So what you could do is you could modify this a little bit, maybe 1%, 1.5%. And then, we can look at those results. And so for today, we've got a couple characters in here that would meet these characteristics. Again, remember we looked at the beginning of the gap down page, and there was a lot of candidates, and here we're down to only 5. Now, there's one last element here I want to talk about is I have a watch list. Now, what I'm really doing here is I'm selecting the pool where I'm going to fish. I'm going to cast out this net to try to find these candidates. Now, I created a watch list that I use on a regular basis that I kind of filter from, of the S&P 500 and the NASDAQ. Now, if you don't have that, those watch lists on your in your subscription page, that's fine. We can do this a couple different ways. So let me show you how to do that. So first of all, what I can do is I can just come up here and change it based on the exchanges, or I can come into the filters again and then go down to where it says sectors or index groups. And in this case, I'll pick index groups and I'll add that. And then there's how you can get those stocks that are in those different indexes, S&P 500, Russell, different sectors. Maybe you're watching a sector you feel like is starting to exhibit some of these characteristics. And again, there's our NASDAQ as well. So that's another way that you can so-called skin a cat, or should I say skin the coyote. So again, I just wanted to show you that. All right, so my results here, 4 results, and then I can save this screener. And again, one of the benefits of being a premium member is I can name that screener, save it. And what I do is I have this screener sent to me in the market open, after about the first hour of trading, or excuse me, about the first half an hour of trading. So I can look at these potential candidates for doing some kind of gap and go trades, or I can start adding them to my watch list. And what I can do is I can just come over here in links, add to watch list, and you can see that we could add Humana to our end of the road watch list. Okay, so that's how we can find candidates. So let's go back to our slides and talk about end of the road setups. So the first that I want to walk through is the day of the gap down. This does present an opportunity for intraday trading, especially for those who are very astute or are quick traders, those of our day traders. Now, I will say that an end of the road setup will also give us other opportunities, even though we might not execute an intraday trade or a day trade. It could be the potential of other types of trades, for instance, an options type trade. But basically, here's the kind of the rules you want to use on the setup. So we're going to sell as price breaks below the opening trading range. And again, as day traders, you might feel comfortable with what you determine to be the opening trading range, 5 minutes, 15 minutes, 1 hour. I kind of look at 30 minutes as kind of my opening trade range. And then we're going to set a stop loss above the previous day's low. Remember, that's how we determine a gap, or I might add more risk in the previous day's close. Again, I want to be just a little bit above them. And then I'm going to adjust my stop immediately upon new intraday lows to above the intraday high. In other words, probably what would be the high on the opening range. So let's go back to our stocks and our end of the road watch list. And I'm going to go to back to the Qs. And what day did this occur? Well, this happened on July 17th. So let's go down to a lower time frame. Let's use 30 minutes, as I said that I kind of like. And, we'll squeeze up this volume a little bit. And I don't need that percentage anymore. And what we can do is just to make this a little bit easier for us to see right now, is I'm going to get rid of those moving averages. So here, oh, no, I didn't get rid of that. There we go. Okay, so here is that opening candle, that first 30-minute candle where price falls down. And then what would we do? If we believe this is going to be a gap and go, we need to wait for price to break the low of the opening range, first 30 minutes, and that would be our entry. Now, initially, our risk would be the low of the previous day, which would be up here, or the close of up here. Now, that might be too much risk, or some traders might not like this type of setup, especially when you're talking about a 2% gap. But as soon as the market makes a new low, as we're seeing here, that's where we would drop our stop just above the opening range. And again, what I said to you, a lot of times these gap and go scenarios, in these gaps, price does not come back. It moves directionally in that first impulse. And then as we make newer lows, then I could adjust my stop accordingly as a day trader. Again, at this point, this might not be, for some of you folks who are not day traders, this might not be something that you'd be interested in. But as an options trader, end of the road gives me a permission to employ some downside momentum trades, right? And I think about maybe bear puts, or if those of you like credit spreads, bear call spreads. Now, I just want to kind of show you this, and this is an element of gap trading, but also element of technical analysis, is that this line here, this red line here, is not referencing the opening price of this red candle, is actually, and it looks like it got moved a little bit here. It should be about there. If I go back to a little bit more a time horizon, yeah, here we go. Let me adjust this. This would be, that old adage, that old resistance becomes new support. So what we see here is that our two candles here where we got the sell signal on the gap and go is where price broke through what would be conceived as a potential level of support. All right, let's go to Lilly. And again, here's our end of the road gap. Here's that potential trade. Now, what is interesting on this one is it doesn't look like we got a real strong sell signal until very end of the day. So for day traders, we wouldn't have that opportunity to take advantage of this trade. But again, as momentum traders, maybe we would take this trade. And again, the other thing I want to kind of point out on this one is notice that here is the most recent level of support and how price sometimes reaches back and tests old levels of support become new levels of resistance. Again, strong end of the road gaps will not allow for full refills. In other words, retracements into the gap, only a partial. So when we go into setting up trades on the first retest, we can also use this as a way to find some good data points or more precise type entries. And then this is a semiconductor company. Now, again, what's just interesting in this one is, again, there's that old support becomes new resistance. So you had the gap down, and then you would, price came back up, and you would still have to wait for that new closing low. Again, at that point, your stop would still be up here, and you might not have gotten a lot out of this as a day trade. And that's why I really think these are, when I start talking about end of road gaps, I really like to talk about that first retest. But again, this retest day of previous support is now going to become a level of resistance. But I also want to kind of show you which is interesting on this one is, let's look down here. Here's our volume, how volume can confirm price. So here is the previous day, big volume on an uptick. The next day, an increase in volume on the opening range. But notice then from that point on, the big volumes come at the close of this particular market. So again, this is more of that adage where novices open the market and professionals close the market. I just kind of wanted to show you that. I thought that was kind of interesting. And then what else did I want to show you on this one? Okay, I think that would be about it. All right, so let's go back to our slides and talk about where I really think the potential for these end of the road setups. So higher probability risk reward or probability reward type trades occur after that first impulse downward, creating these short-term bottoms. So what we want to do is we want to wait for price to return or retest that previous gap down, that end of the road gap. And we're going to look for concentric data points before entry. And again, these data points could include our moving average, our retest of our moving average, a broken support, which I kind of just showed you on those intradays. Fibonacci retracements is a really good tool to use. Again, that partial gap fills, but we also could look at some other technical analysis. So I just definitely want to show you those as we move through a couple of our examples here. So let's go back to our charts and let's go to Dell. So let me do this. Let's kind of clean this up a little bit. We already kind of looked at this, but let me, before I move away from here, again, look at, there's our series of gaps as we get to that parabolic movement. And then, our kind of our island reversal up here. So what we're going to look for now is, let me change my template here to just a clean template. What I'm going to look for here is, where do I think the market is going to retest? In other words, let's start looking some of those data points that we can rely on. So the first one we'll do is we're going to wait for price to make a low after the end of the road gap. And then we're going to create a Fibonacci. And that's exactly what I did here. So I have a high and I use the low here, and then I have a Fibonacci retracement. So let's talk about Fibonacci retracements in terms of bulls and bears. Now, in bull markets, what you'll typically see is retracements will hold that 23 or that 38 level, but bear markets are a little bit different. And this is just a general rule. A lot of retracements in bear markets will go to that 61.8 level, or that 62, which are, kind of rounding it up. So there is a difference between, again, that's more of a generality. So now I see that price is returned to an area where I believe that it's going to falter around that Fibonacci retracement. But again, also, if I think about those previous levels of support that are now going to become resistance, so this would be right in this area would be a level of support. But again, you can see here that there is another little minor level of support. So in here, between here and here, I know that these levels of support are now becoming levels of resistance. So there's this confluence of these two areas. And again, if it's a strong gap, we're not going to get a full retracement into that gap. And again, you can see that price does return to that gap level, but it does not fully retrace. Now, we could also look for lower time frame evidence. And here I'm in a 30-minute time frame. So let's add one of my favorite tools, and that is Bollinger Bands. And what we can see here is on the day of price returning to that Fibonacci level in that retest zone between where I found old support, that we got a Bollinger Band piercing. And if you understand the physics or the theory behind Bollinger Bands, when price deviates outside the Bollinger Bands, there's a low probability occurrence, but a high probability mean reversion setup. And so that would have been giving us a little bit more confidence. Maybe we still would wait for a confirmational entry, price to fall back below the Fibonacci level and back inside the Bollinger Band before we actually set about taking a short position. But as options traders, at this point, I could say, oh, and now I'm going to start designing my bearish momentum options trades. And the other tool that I kind of like to use on day of, as price is approaching my retest zones, is I'm going to go inside of our bar chart templates. And there is one template that I use a lot, which is our 13 EMA pivots. Now, I can't go back in time and recreate the pivots that were designed for that day, but I can show you the pivots that are designed for today. But what I would do is, because the price is rallying into my area of what I believe is going to be my area of entry, what I might do is look at some of those secondary levels of resistance based on our pivot values. And you can kind of see today that Dell had a big, strong opening, but it rallied right into resistance based on floor pivots. And then the 13 EMA is kind of an intraday moving average. And so maybe you're waiting for confirmation for you to break this 13 EMA, and that might be your confirmational entry. All right, so where am I at? Okay. Let's go to, I think this is Kimberly Clark. Okay, and let's go back to our daily. And again, let me change my template back. to something that is a little bit more simpler to see. Again, here's our previous support. There's our end of the road gap. And then boom, price comes back to that gap, giving us a partial fill. But notice how the tip of this shadow or tail or wick, whatever you want to call it, touches the tip or shadow or wick of the previous down candle. That is a really nice, precise type entry. Again, if I go to a lower time frame on this one, notice that our level of support right there, and there was our potential entry. Now, I'm just curious in this one. I didn't look at this before I came on. Let's just see what our Bollinger Bands. Oop, there you go. Our Bollinger Bands piercing outside and then price coming back inside of this. Again, maybe not a great day trade setup, but certainly for somebody who's a positional trader or a momentum trader, well, what a nice entry on that one as well. Okay. So I do see a couple of questions, Gene. So let me take a moment here and see if I can answer some of these questions. And I want to give you guys a couple of takeaways before we finish today's session.
Yeah, one thing I do want to mention, a few people have asked, John showed a screener with a couple different filters. If you go to our webinar archive page, there is a link to download the slides and John's template setup for that screener he went through that's part of the slide, so you can find it in the Learn menu under Archived Webinars.
Yeah, I have it in my slides. I'll show that in a second, Gene, and then also I'll show you guys as we finish up too. So I think I'm just going through a lot of these questions. I feel like I've answered a lot of these. I see a couple people are asking to look at specific markets. But here's one that says, do you see silver and gold or the ETFs, the SLV and the GLD commodities in the same way? There's a lot of gaps. Yeah, so let's talk about gaps as for instance, for gaps for us, say the Qs or the SPY. We have to understand that, what does an ETF represent? Well, in the equities markets, let's say, the SPY or the Qs is a number of stocks, 100 stocks, 500 stocks, 1,000 stocks. So the probability that every stock that is in that ETF, when price comes back to that gap or when price is returning to that gap, the probability is they're not going to be exhibiting that same gap type activity that created the original gap, right? There's just too many moving pieces. So we can't be as precise with gaps. Gaps that are ETFs that are based on a commodity, for instance, gold and silver, right? The way they create that ETF, the derivatives they use, usually futures and options, they change from day to day too. And remember, the ETF only trades between 9:30 and 4 o'clock in the afternoon. But gold is a 24-hour market, right? So there will be a lot of gaps in those types of ETFs. But if you wanted to do end of the road gap analysis and you wanted to trade the GLD or the SLV, what I would recommend to you is look at the underlying commodity in its futures form and see if you see those types of trades. So that's kind of just a little bit of a tip there. Okay. Yeah, so I knew I was going to get this question. Would there be a beginning of the road? Yeah, I mean, there's a yin and yang to markets, right? And again, Edwards and McGee says that there's this cycle of gaps when it comes to trends analysis. So can there be a beginning of the road as markets make bottoms and reverse? Yes. but the characteristics are slightly different. And remember, bears take the elevator down, bulls take the escalator up or the stairs up. So a lot of the retracements come a little bit quicker, and also you get a lot of little back and forth movements in bear markets. So it's just a little bit of the nuances, but can you use the same criteria in reverse? Yes, you can, especially when you're looking at gap ideas. So what's Mike Reed asks, what is the percentage of an equity outside of a Bollinger Band? All right, so Mike, we do have a Bollinger Band webinar, but here's the probability. Says that about 95% of all price action falls inside of two standard deviations. The Bollinger Bands that I showed, the defaults we have on our website, are two standard deviations. That means that price is only outside of Bollinger Bands the upper or lower 5% of the time. In other words, once in every 20 days or so. So it's a rare occurrence, but under Bollinger Band theory, when the bands get very wide and then price deviates outside of it and then comes back in, that is called, I set up for, it's called a mean reversion. But you can use Bollinger Bands for breakouts as well. So I think that is a lot of the questions I got. So let me get to our, and again, if I didn't answer your questions, I apologize. Send your questions to support@barchart.com. We have a great staff that can help with you, especially if it's about something that I showed you where to find that. But if you have a very specific question about the webinar, send those to me. They'll pass them along to me, and I'll get around to answering them. So if you have any questions. All right. So this is what Gene was talking about. In the slides, there's that end of the road screener that you can use. And again, this is just a pool of candidates that I was fishing from. Again, you could pick your own pool. And so what are some of our takeaways of today's session? Remember that gaps represent the most significant imbalance between buyers and sellers. Well, we've learned now that gaps are an absence of buyers or sellers. And this is very, very significant in terms of looking for potential opportunities. Gaps can predict, affirm, and warn us of reversals regarding that trend analysis. And remember that cycle of gap sequencing, breakaways, runaways, exhaustions, and reversals. Not all end of the road gaps are island reversals, but you will see a lot of them. And end of the road gaps typically break that very discernible long-term or intermediate trend line. They violate moving averages. I showed you the 20-day. I think that's a really good one to kind of focus on. But I think there was a couple examples in today's slides of where it broke below the 20 and 50. Maybe we'll go back there in a second. And again, what is the catalyst, right? I don't really necessarily care about what the catalyst is, but usually there is a catalyst that shocks market sentiment. Now, typically that could be something like earnings. And today, we've got the Fed. So maybe tomorrow we might see some end of the road gaps as the market reacts to what the Fed said today. All right, and then again, this is the real reason why we learned this theory or this end of the road gap is because gaps act as a magnet and draw price into them. Strong gaps will not allow the market to retrace fully, but we can start looking for those convergence of technical analysis, old support, Fibonacci's, Bollinger Bands, previous lows, all these things. When they start converging in a very specific area, then there's where we can be a little bit more precise, but we still might want to take some kind of confirmational entry. In other words, wait for price to come into that level and then exit from that level before we take that short type trade. And these, I think, you'll find will offer you the best of opportunities. Okay, so one last slide again. I showed you a lot of cool features that we use on our website, the screeners, the multiple templates. Again, some of the benefits of being a Plus or Premium member is the number of templates or screeners that you can use. Premium members get unlimited amount of screeners and templates. So you can try out our subscription for a 30-day free trial period. So again, talk about trades. I think that is a low, very low risk trade. Okay, let's go back to, since I got a couple minutes here, I want to go back to the cues here for a second. Actually, let's go to Mo. And no, it wasn't Mo. I thought Mo fell through the 20 and the, okay, here, so here was Kimberly Clark, right? So the end of the road gap fell both below the 20-day and the 50-day. So that was a combination of sell-offs, and I'm sure that this one was probably, let's just check. Not an yes. So here's our end of the road gap, which was an earnings gap. Okay, so I was off a little bit there. All right, so let's go back to the cues here for a second. And let me do this. Let me clean up. Well, let me do this. Let's get rid of the volume for a second. All right. This is one little bit of bonus of it. So an end of the road gap, maybe we didn't get the opportunity on a day trade. Maybe the market hasn't retraced, right? It's been a while. Maybe it's been days or weeks. Maybe it's been a month. I don't know. But what do we see here? What do we see in the cues here? So I see an end of the road gap, which I know that is probably telling me that this trend is over, right? And then what has happened is we've made another gap. Well, what does this gap represent in trend analysis? Well, this gap represents, here's our breakaway, and now we're getting our runaway or continuation gap. So could this gap be a trading opportunity? Is it an end of the road gap? No, it's not. But could it be a trading opportunity? I think it could. Well, why? Well, first of all, it's just right around the 50-day moving average, and it's below the 20-day moving average. And if I use my Fibonacci retracement tool, notice that that gap is between that 38 and that 62%. So where would I be looking for an opportunity? Somewhere's around in here. Again, if I go to a lower time frame, day of when price returns in here, I could use my pivot points. I could use maybe look at Bollinger Bands to see if price has gotten a little bit ahead of itself, or I could go back in time and look at, there's our 50% retracement, there's our 62% retracement, there's our 38% retracement. I could look at previous levels of support or resistance, and notice that we do have a level right there around 475, and another one here around, looks like around the 478 level. So just keep that in mind over the next couple days. All right, folks, that brings us to the top of the hour. I hope you enjoyed today's session. Next week, we're going to talk about another one of my favorite chart patterns, and that is it up, Gene? I believe it is, right? Oh, it's not up yet. We haven't put that on, my bad. That will be the cup and handle formation. But in here's the archives, is what Gene was saying. If you go to the end of the road gap pattern, this is where you can find the slides for today to help you with what you've learned today. So until next time, thank you so much for joining us today. I hope you appreciate it. and hope that you got something out of today's session. The best of health, manage your risk, and the good of all trading.